shut down. Shut it down.
Be shutting down.
U.S. auto sales abruptly closing their dealerships.
The 2025 car market crash is here, and many are about to lose big. But what if you could save thousands instead? The key is knowing how to navigate this chaos.
Car dealership is temporarily closed.
How to find hidden gems, make smart financing decisions, and understand the true value of your trade-in. Stick with me to uncover the strategies that will turn this downturn into your opportunity for massive savings. What's happening? As we step into 2025, the car market is showing clear signs of distress. Prices have been rising steadily, far outpacing the growth of consumer wages, making it increasingly difficult for the average buyer to afford a new vehicle. The rapid inflation in car prices can be attributed to factors like ongoing supply chain issues, rising manufacturing costs, and the growing demand for more advanced technology in vehicles. But despite the spike in prices, a looming market correction is on the horizon, threatening to shake the foundations of the industry. Overproduction has become a major issue, with manufacturers producing more vehicles than the market can sustain. Dealerships are being flooded with unsold inventory, which continues to pile up, unsold, and gathering dust on lots across the country. As these vehicles sit unsold, dealerships are finding themselves under increasing financial strain. The costs of maintaining such high levels of inventory, along with the need to move cars quickly, are forcing dealers to slash prices and offer large discounts. But even with these aggressive sales tactics, the vehicles aren't moving fast enough, and the situation continues to spiral. As the car market faces a correction, it's clear that this downturn isn't just a challenge. It's a goldmine for those who know how to navigate it. But how can you make the most of this opportunity? The stock market analogy. The car market crash in 2025 shares many similarities with stock market crashes. Just like stocks, car prices fluctuate based on various factors, including supply and demand, consumer confidence, and overall economic health. The key to making the most of a downturn is to understand the market's unpredictable nature and recognize opportunities when they arise. Much like the stock market, the car market is subject to periodic cycles of ups and downs, and knowing how to react when things go south can make all the difference. Take, for instance, historical stock market examples like Polaroid and Kaiser Industries. In the early 1980s, Polaroid was a company everyone believed in until it wasn't. Its stock price plummeted, but the company's fundamentals hadn't changed. Investors who understood the company's true value were able to buy in at a steep discount even though the stock continued to drop in price. Similarly, when Kaiser Industries stock fell from $26 to $10, many investors were nervous about how much further it would fall, but those who understood the company's assets, like its stake in Kaiser Steel, aluminum, and Jeep, saw the potential for recovery. By the time the company reorganized, it was worth far more than its market price had suggested during the downturn. The lesson here is clear. Markets can be unpredictable, but that doesn't mean opportunities aren't hiding in plain sight. Just like investors in stocks can make money by buying low and holding for the long term, savvy car buyers can make huge savings if they know what they're looking for and how to time their purchase correctly during the crash. Market timing. In a volatile market, timing your car purchase is everything. Just as stock prices fluctuate, car prices follow similar patterns, often dipping at predictable points. The trick is recognizing when these dips occur and being prepared to act quickly when they do. During a market downturn, car prices will often drop significantly as dealerships try to clear excess inventory. Knowing when to make your move can help you save thousands of dollars. The key to market timing is understanding the cycle of price fluctuations. Just like in the stock market, there are moments when prices are artificially inflated due to demand or hype. When the bubble bursts, it's crucial to be ready to buy. The best deals tend to appear when prices fall drastically, much like a stock plummeting in value. If you buy when the market dips, you can secure a deal that not only saves you money up front, but also positions you to avoid rapid depreciation down the line. The principle is the same as buying stocks during a market correction. It's about finding value during the downturn and being patient enough to wait for the right moment. Understanding car values. Before you make a car purchase, understanding the true value of what you're buying is critical. The car market is filled with models that may look appealing based on price or reputation, but what really matters is the car's long-term worth. Just like investors research stocks, potential car buyers should research the brand, model, and market trends to make informed decisions. Start by evaluating the brand's reputation for reliability, long-term performance, and how well it holds its value. Researching the specific model's depreciation rate can give you a sense of whether it's a smart investment. Some cars lose their value faster than others, meaning you might overpay if you're not careful. The long-term trend matters more than the initial sticker price, and understanding how the car fits into the market can help you spot potential deals before others do. By understanding the true value of a car, you're not just making a purchase, you're making an investment. Knowledge is power. When you understand what you own, you can avoid overpaying or being stuck with a car that loses its value too quickly. Dealerships and the pressure to discount. As the market struggles, dealerships are under increasing pressure to clear out inventory. This creates a unique opportunity for savvy buyers. With unsold cars sitting on dealership lots for extended periods, many dealerships are offering significant discounts or added incentives to move inventory quickly. For you, this means the potential to buy a car at a fraction of the original price. Understanding the pressure on dealerships can help you leverage this situation to your advantage. Dealerships need to move cars, especially when they are overstocked or facing a slowdown in consumer demand. This urgency often leads to price cuts, rebates, and special financing deals. For buyers, this is a golden opportunity to snag a great deal. But timing is everything. Wait too long, and you might miss the best prices or deals as stock moves or discounts are reduced. Keep an eye on dealership sales tactics like promotional events, clearance sales, or end-of-month deals, which tend to offer some of the biggest discounts. When you recognize the pressure dealerships are under, you can make a move that benefits your wallet. The risk of overpaying. In times of market volatility, there's a tendency for people to rush into purchases, thinking they're getting a deal, when in reality, they're just buying into hype. This is particularly dangerous when prices drop sharply in response to a market downturn, leading to inflated perceptions of value. It's easy to think that just because a car is priced lower than usual, it's a bargain. But without understanding the true worth of the vehicle, you might still be overpaying. Take the example of Polaroid's stock crash. Investors rushed to buy the stock when it dropped from $100, believing it was a great buy at that price. But by the time it hit $18, those same investors were left with significant losses. Similarly, in the car market, prices can fall dramatically, and consumers may rush to buy, thinking they're getting a deal. The danger is that, without understanding the quality, reliability, or long-term depreciation of the car, they end up overpaying even at a discount. When a car's price drops, it's important to assess whether the drop is driven by legitimate market factors or if it's simply part of a trend that could lead to a further loss in value. Always do your research. Don't just buy on impulse because the price looks attractive. It's easy to get caught up in the hype, but by focusing on the vehicle's true value, you can avoid making a costly mistake. How the crash affects you. The 2025 car market crash has sparked a chain reaction that ripples far beyond the car dealerships themselves, significantly affecting local economies, especially in regions that are heavily reliant on the automotive industry. In areas where manufacturing plants, dealerships, and related industries form the backbone of the local economy, a downturn in the car market can be devastating. With vehicle prices escalating and consumer confidence waning, these regions are beginning to feel the full weight of the crash. In cities like Detroit, Michigan, and towns in the Midwest where automotive plants have long been the major employers, the effects of the car market crash are nothing short of catastrophic. A significant portion of the population depends on jobs that are tied directly to the automotive industry. When car sales plummet, dealerships reduce staff or close their doors, and manufacturing plants may scale back production or even shut down temporarily. As a result, thousands of workers are left without jobs, and local economies take a major hit. The entire community feels the pressure of fewer paychecks being spent, lower demand for local services, and less money flowing into the economy. This isn't just a problem for the workers in the car industry. As automotive jobs dry up, the ripples are felt across all other sectors. Local businesses such as grocery stores, service providers, and even schools begin to feel the strain. Less disposable income means less spending, which hits the local economy hard. The unemployment rate climbs and economic stagnation sets in. While the national economy might show signs of recovery, these small communities might remain trapped in a downturn for much longer, struggling to regain their footing. But it's not all doom and gloom. For consumers, this presents a unique opportunity. The crash creates an environment where certain industries may be ripe for new investments. The excess of unsold vehicles creates an opportunity for buyers to swoop in, particularly those who have cash available or good credit. While many people are tightening their belts, others can take advantage of the lowered prices and aggressive discounts to make purchases they would otherwise find unaffordable. It's a harsh reality for those who rely on the auto industry for their livelihood, but for the discerning buyer, the crash offers unique chances to capitalize on lower car prices and reduce demand. Job losses and dealership struggles. As the car market crash deepens, dealerships are finding themselves in a dire situation, facing the very real threat of bankruptcy and layoffs. Unsold inventory is piling up, and decreased demand means that dealerships are struggling to stay afloat. With fewer customers buying cars, the margins that dealerships rely on are shrinking rapidly. Dealerships, often operating on thin profit margins to begin with, cannot afford to maintain large inventories of unsold cars indefinitely. For many, this means making drastic cuts to staffing and operations, or even closing their doors altogether. The strain on dealerships doesn't just affect salespeople or administrative workers, it affects everyone in the ecosystem. Service technicians, finance officers, marketing teams, and even janitorial staff are all feeling the effects of reduced business activity. The ripple effect of these job losses extends beyond the dealership lot and into local communities. When a dealership closes its doors or lays off employees, the economic impact reaches far and wide. Unemployment rates rise, and the pressure mounts on social safety nets as families are left without income. But the reality for dealerships isn't all negative. While the market crash may lead to job losses, it also creates a unique opportunity for buyers. When dealerships struggle, they often need to clear out inventory quickly to make room for new models. This leads to slashed prices, heavy discounts, and a variety of sales incentives to move unsold cars off the lot. For a buyer who understands the market, this could be an opportunity to purchase a car at a significantly lower price than usual. Consumers who are financially prepared to act quickly can benefit from the situation. However, it's crucial to approach these opportunities with caution. Understanding the financial health of a dealership and the actual value of the cars being sold is key to ensuring that you don't fall victim to purchasing a car that could be a financial burden in the long run. But for those who can make informed decisions, the market crash can be an avenue for finding great deals on cars that were once priced out of reach. The debt trap. Along with rising car prices, another significant issue plaguing the car market crash is the increase in auto loan rates and the phenomenon of negative equity. Negative equity refers to the situation in which a consumer owes more on their car loan than the car is actually worth. This issue is exacerbated by the crash, as rising prices and tight lending conditions make it harder for buyers to secure favorable financing. In many cases, buyers who financed their car purchases before the crash are now facing a situation where their car has depreciated in value, but their loan balance remains high, leaving them underwater on their loans. Negative equity is particularly troublesome when buyers attempt to trade in or sell their vehicles. As the car market crashes, trade-in values drop, meaning that many consumers owe more on their loans than they can get from selling or trading their cars. This situation traps buyers in a cycle of debt where they can't sell their vehicles without facing financial loss, and they may struggle to finance a new car. For many, this leads to an inability to upgrade to a more reliable vehicle, leaving them stuck with a car that isn't worth what they owe on it. The rising auto loan rates add fuel to this fire. As interest rates climb in response to economic instability, monthly car payments become more expensive, which only increases the debt burden on consumers. As the cost of borrowing rises, many consumers find themselves stretching their budgets to make car payments, leaving little room for other essential expenses. This can lead to a host of financial problems, including the risk of repossession. For those considering a car purchase during the crash, it's crucial to be mindful of these risks. Taking on a loan with high interest rates or excessive debt can lead to long-term financial hardship. To avoid the debt trap, it's important to understand the full scope of the financing agreement and ensure that the loan terms are manageable. It may also be worth considering waiting until market conditions improve, or finding alternatives to purchasing a new car, such as leasing or buying a used vehicle with a lower loan balance. Waiting for the right moment. In a volatile car market, patience is not just a virtue, it's a strategic advantage. The current car market crash presents an opportunity for those willing to wait for the right moment to make a purchase. The crash has caused a dramatic shift in prices and dealership strategies, meaning that prices are likely to fluctuate even more over the coming months. While it might be tempting to make a quick purchase to take advantage of current sales, waiting for the market to stabilize could yield even greater deals. For those who are able to wait, the value of patience in this scenario cannot be overstated. The current market presents a situation where cars that were once out of reach are now coming down in price. However, prices could continue to drop further as dealerships struggle to move their inventory and adjust to the realities of oversupply. By waiting, consumers may be able to purchase a car at an even lower price point, taking advantage of further discounts and falling prices. Waiting also allows consumers to track which models and brands are seeing the greatest price reductions and which ones hold their value better. Understanding these dynamics means that when the time comes to purchase, buyers will have a better sense of which vehicles are truly worth the investment. In addition, waiting for the right financing deals could make a significant difference. With lenders tightening their standards, interest rates on auto loans may be high right now, but waiting could allow buyers to secure a more favorable rate once the market stabilizes. Patience during this volatile period will allow consumers to take full advantage of the car market crash and save money in the long run. Instead of rushing into a purchase and risking overpaying, buyers can afford to wait for the right deal, ensuring that they make a sound investment. This approach also provides time to evaluate alternatives, like leasing or opting for a used vehicle, which may offer significant savings without the burden of inflated prices. What to look for in a deal? In the midst of a market downturn, the temptation is to rush for the biggest discounts, thinking that the lowest price always equals the best deal. But not all deals are created equal. In fact, some of the best buys during a crash are cars that are undervalued yet offer long-term benefits. So how can you identify those hidden gems? The key is to look beyond the immediate price slashes and evaluate the car's long-term worth. Think about the brand's reputation for reliability, the car's fuel efficiency, its maintenance costs, and how well it holds its value over time. A deep discount might seem appealing now, but if the car is prone to breakdowns or excessive depreciation, it could end up costing you far more in repairs and lost value down the road. Start by focusing on models with a strong resale history, which can be an indicator of how well they retain value. Even in a market crash, these vehicles are likely to hold their ground better than others. For example, brands like Toyota, Honda, and Subaru often fare better during downturns compared to luxury brands or less established names. Also, pay attention to inventory overstock. While it may seem like there's a massive sale on everything, some cars may be in excess because they're harder to sell or don't meet the market's evolving demand. Cars with a high supply but low demand could quickly lose value, making them a risk rather than a deal. In short, a hidden gem is a vehicle that provides value over time, not just a short-term discount. If you choose wisely, you're not just saving money today, you're investing in a car that will save you far more over the years. Financing your purchase smartly. When the car market is in turmoil, financing options become more important than ever. Buyers are increasingly relying on loans to afford new cars, but in a volatile market, the wrong financing decision could leave you financially strapped. So how can you finance your purchase smartly? First, start by exploring low-interest financing deals. Many dealerships offer incentives like 0% financing for qualified buyers, which can help you save a significant amount in the long term. But you must have strong credit to take advantage of these offers. If you don't, consider securing financing through your bank or credit union, which may offer better rates than dealership financing, particularly during market downturns. It's also critical to avoid getting locked into unfavorable loan terms. In times of market instability, it's tempting to stretch your payments out as long as possible to lower monthly payments. However, this can result in paying far more than the car is worth in interest, especially when the market rebounds. Opt for shorter loan terms if you can, as this will minimize the interest you pay over the life of the loan. Additionally, consider your down payment carefully. A larger down payment can help lower your loan balance and monthly payments, giving you more financial flexibility down the line. Remember, the goal is not just to secure financing, but to secure financing that keeps you from getting overwhelmed by debt. Lastly, avoid overpaying for unnecessary extras in the loan agreement. Extended warranties, insurance, and service plans may seem appealing, but these often come with hefty price tags that can add to the financial strain. Always assess whether these add-ons are worth the cost in the long term. Understanding depreciation and trade-in value. When you're looking to purchase a car during a market crash, it's crucial to consider depreciation and trade-in values. Depreciation is the rate at which a car loses its value over time, and understanding how it works will help you make smarter decisions now and in the future. In a volatile market, cars can lose value faster than usual. For example, a new car can lose up to 20% of its value as soon as you drive it off the lot, and this depreciation can be even steeper in a market downturn. While depreciation is inevitable, it's essential to know which cars depreciate the least. Typically, brands with strong resale value, like Toyota, Honda, and certain luxury brands, tend to lose value more slowly. Think ahead. How easy will it be to trade in your car in the future? If you're buying a vehicle in the middle of a crash, you want to make sure it will retain enough value that you can trade it in when you're ready to upgrade. Pay attention to vehicles that tend to have higher demand in the secondhand market, as they're more likely to retain their value and offer better trade-in potential. Also, consider how the market crash affects trade-in values. Dealers will be eager to move inventory, but they may not offer the same trade-in value they would have in a healthier market. It's essential to do your homework on current trade-in values for your car and compare them with similar models before making a decision. Historical trends to predict the future. The key to surviving and thriving in the 2025 car market crash is to look to the past. Historically, car markets have always followed cyclical patterns, with downturns and crashes followed by recoveries. By understanding these historical trends, you can predict when to buy, how much to pay, and which vehicles are likely to hold their value. One important pattern to note is how overproduction often leads to significant inventory accumulation during market crashes. When this happens, prices drop and the savvy buyer can scoop up deals at rock-bottom prices. Historically, the best time to buy is when demand has bottomed out and manufacturers are desperate to clear out their overstocked inventory. Additionally, the post-crash rebound often favors certain types of cars more than others. For example, compact sedans and mid-range SUVs tend to recover quicker in value than niche luxury vehicles or gas-guzzling trucks. If you're planning to hold onto your purchase for a few years, focus on vehicles that have historically had strong resale value after market corrections. By applying these historical insights, you can avoid overpaying for a car now and instead wait for prices to drop to a more reasonable level. Recognize that downturns are temporary, and with careful consideration, you can get ahead of the market rather than falling victim to its immediate fluctuations. The 2025 car market crash is a chance you don't want to miss. With the right strategies, you can save big. What are your thoughts on the current car market? Drop a comment below.